Self Wealth Live, our technical analysis edition for this week, and we are here to answer all your questions, pointing at us, the experts today, and that would be Jason, obviously. Jason, how are you today?
Hey Roger, I am good, thank you. Good to be back on the show. Talk about some stocks and some markets and all of that stuff.
Yep, exactly. It's all starting to unfold a little bit now, I see. So yeah, it'd be good to see your take on it when we get to there. Let's show our disclaimer to our viewers, if that's okay.
Yeah, okay. So as always, everything today is general commentary only. So no personal advice given. And I just quickly put up this disclaimer we show each week. I'm not part of Self Wealth. I'm from Motion Trader. So that's my disclaimer up the top, all the licensing details and such. And Self Wealth disclaimer is below that. So again, yeah, it's just all a general commentary only.
Fantastic. I love some general commentary around the markets. So let's dive into it then. And now let's have a look at the ASX. It's already come off about 100 points this morning, so it's a pretty big move down. So what do you think? What does it look like?
Yeah. So we just get our chart up on the screen, and it's been really like this consolidation started a couple of weeks ago. We had an all-time high just before Easter, and the market's been pretty much going sideways to pulling back since then. And just in the last couple of days, we've accelerated a bit on the downside. On balance, when you just compress this up and you look at the overall structure of the chart, like using that October low, on balance, you say the upward trend is still in place. Like it's been a fall for a lot of people, but this is what we get in rising trends. We get pullbacks. So I'll look at the 50-day moving average. I look at the 100-day moving averages. They're still positive. The price has come back below the 50-day, which is something which does happen within a rising trend. It's still above the 100-day average, and it's sitting on support at around 7,600, and that takes in these previous high points. So, as I say, I think at this point we've got to work on the basis that the overall upward trend remains in place. And I think the concern a lot of people have when they do start seeing these pullbacks, and not dissimilar to the pullback we saw during December, people start to worry, well, look, is it all over? Is this the start of a bigger decline? But often what we see is that these pullbacks turn out to be just routine pullbacks within an overall rising trend. I'll come back and we'll talk a little bit more about this when we cover the US markets in a minute. But at this stage, I think the default position should be that the trend remains up. So my focus at the moment is with my own stocks, my own portfolio, is I want to stay in my stocks which have been doing well. I don't want to get knocked out of profitable positions on what could turn out to be something like we saw in December, a relatively minor pullback. Now, sure, it could develop into something larger, but at the moment we don't have enough information to say that's the case. So that's why I work on the basis that a pullback is just a minor to moderate pullback, not a major correction. And I think this is one of the things a lot of people struggle with, Roger. They get these pullbacks and then they sell their best stocks because they're worried they're going to keep pulling back. And so rather than trying to see off a consolidation, and they start worrying that the top's in, and as I say, they sell those good stocks too early. And I think, look, as you've heard me say many times, I think the play here over the last few months, I think the play here is to hold on to your stocks which have done well, but also just like we've talked about for weeks now, just stay away from stocks which have run really hard, because they're the ones with the most downside when the market pulls back. And we're also got to bear in mind that the last 5.5 months have been some really strong trends. So it's only normal that you do get that larger pullback starting to develop at some point. I still think the strategy to use here, wide trailing stops, and the strength of these wide trailing stops. So a wide trailing stop is an exit point which travels up beneath the market. And I think it helps set you up for three scenarios. So scenario one, if prices stabilize quickly and start going up, well, it keeps you in. If prices want to chop around for several weeks or longer, you get a moderate sort of pullback. Well, those wide stops can keep you in that as well. But if what we're seeing now turns into a larger downturn, well, then those wide trailing stops, they ultimately trigger, and that gets you out of the market. So you're trying to play off three scenarios. We don't know which one it is at the moment. Is this a short pause and then upward again? Is it a larger sideways period, or is it a start of a bigger downturn? We don't know. But the wide trailing stop really does cover us for all three of them.
Yeah, well, it'll be interesting to see if it. I mean, obviously you've marked it in there. It's reached now. It pulled back to that previous support zone, what used to be resistance, now become a bit of a support zone. It'll be interesting to see if it pushes through that now. So over the next coming days, we'll see what happens, I guess. And for those that are new, and coming in and just starting to watch us for the first time, understand that we are here to analyze and show the charts from a price and charting perspective. Whilst we may touch on some fundamentals here and there, it's very lightly. And that's probably relevant to this question that's just popped up. But before we get to that, we'll get to the we'll do the rest of the markets first. All right. So this can really add, if you're a fundamentalist, having a look at the charts and understanding how to read the charts is a great tool to have. Next to understanding company reports, economic reports, all these things that people talk about on the news. They don't really analyze charts very well on the news. So being able to analyze charts like we do, having that tool in your belt can really help you out in staying in longer trends, as you've been saying over and over, as we've been trying to educate people over and over again, right, Jason? So
yeah, well, what you do when you look at a chart, you're really taking the market's temperature. You're saying, is the market hot? Is it cold? Is it cooling? Is it warming? And we don't want to buy into a cooling market or a cold market. So that'd be a market which is trading below its moving averages. And we want to look to actively buy when a market is moving upwards above rising moving average. So at the moment, we've got a market which is it's certainly coming off the boil, and which isn't surprising because we've had that large move up since October, where we did have a market which was heating up quite nicely. We've got some great trends out of that. But now we can see that we're going through a cooling phase. So it's one of those times where you can just take a step back, manage your risk, not be in a hurry to do a great deal. Buying the dip is all well and good, but I like to wait for the market to stabilize first. And that's what these charts are all about. Being able to understand your way around a chart, it's being able to assess that temperature of the market. When do I want to be involved, and when should I just take a step back and see how things play out?
Yeah, and when you start to develop that chart eye, as you say, right, it doesn't take a lot of time, really. It's super simple, and it takes 5 to 10 minutes, right? So that said, let's get on to the US markets then, Jace. Let's have a look at that.
Yeah, so we'll go over to the S&P 500. And so look, last week, Roger, we were talking, and we said that, it's be patient with buying. And it turns out that, it's been worthwhile being patient with the buying, with the S&P 500 coming back, having its first trip below the 50-day moving average since November. Got to come all the way back down here to November to see have the market below the 50-day moving average. And of course, it's the top average is a 50-day. Below that, I've got the 100-day moving averages. And now I think that the concern, as we're talking about with the ASX, the concern for many investors is that is a larger pullback getting underway, and that's always a possibility. You never know. You only can look back in hindsight and know for sure what's actually gone on. But I think it's at this stage, I think it's just too early to be calling an end to the overall bullish market. And I think an important thing to remember, to keep in mind, is that on average, the S&P 500 has around 3% pullbacks each year. And then it also has about 5% pullbacks each year. So what we're seeing, when you look at it from that perspective, what we've seen over the last few weeks, it's really nothing out of the ordinary. And it's actually, the market's down about touch over 4% at the moment. So this is the first time we've seen a pullback of more than 3% since May last year. So you've got to come all the way back over to this period. It's almost a year ago, May last year, since we saw a 3% pullback. Now, of course, we've got this bigger 11% correction in the middle there, but in terms of looking at our 3 to 5% variety, there hasn't been one since May. All these pullbacks we've seen over the course of this year have all been around that 2% mark, a touch either side of that. So we're now getting one which is over 3, but so far less than 5. If we were to see the market down 5%, it's about halfway between the 50 and the 100-day moving averages at the moment, just where I've got the cursor. So we're just above that 5% mark just now. And I was asked a really interesting question in the media. I was on the on a live news show through the week, and I was asked, what signs do I look for to identify a top? And my answer to that was that we can only identify a top in hindsight. And so I work on my base position. When we're in an upward trend and the market pulls back, my base position at the high is going to be that the trend is still up. And I'll view the initial 3 to 5% decline as being part of that routine phase that we go in within an ongoing advance. I think that should be the default position. So of course, at some point, the default position is going to be wrong and you're going to get a bigger pullback, but often it is just those routine declines. And if you don't take that view, I think it's hard to really stay on these big trends that can go on for multi-months or even multi-years, because you're always jumping out every time you get a 3 or 5% pullback. And look, there can definitely be warning signs. There can be cause for caution, often causes for caution. There's nothing wrong with that, pulling back some risk, being patient with your buying, that sort of thing. But the trend is up until it breaks down. And what's interesting to do, just quickly, just take you back to the 2021 period, just through this rising period that you can see on the chart where the cursor's moving. During this period, there were several times that the market came back 3 to 5%, but each time sometimes we got through the 50-day moving average, but almost always, with a few exceptions where we had a brief touch below the 100-day moving average, the 100-day moving average pretty much held, and this large rising trend remained in place. So if you're jumping out every time you get a 2 to 3 to 5% pullback, you're always jumping out of the market. That's the stock market for you. We're always dealing with uncertainty, but you've got to be able to see off a degree of it and give your trades room to move. Again, why I keep coming back to wide trailing stops. Wide trailing stops help take the emotion, help take the having to second guess what's the market going to do every day, because you can have a calculated point where you say, okay, enough is enough. Now I need to get out and protect capital. But until that point arises, I can try and stay on the trend. So I've reduced risk a little bit over the last week, but I still think overall the play is hold profitable positions, wide stops, be patient with your winning positions. But with the losing positions, I'm not so patient. I'm happy to push those losing positions out of the portfolio reasonably quickly when they're not working and the market's pulling back. And that's where I've been able to just reduce risk over the last week.
Yeah, well, look at and like you said, Jason, imagine all these people that don't understand these concepts, right? I mean, paying the brokerage is great for the broker. So lucky you've got a company like Self Wealth that only charges $9.50 brokerage for a fixed order size, right? But if you got some of the bigger banks, you're paying them a lot of brokerage to go in and out of a stock all the time, right? So, all right. So let's have a look at the Hong Kong and Chinese markets then.
Okay, so quick look here, not a huge amount to report during the week. So I'm just going to move this support line along a little bit. Fairly quiet in the Hang Seng, holding its ground above this support at around 16,300. Came close to making a new high last week, but then just fell short, started to pull back down towards support. The longer it can consolidate above this support, the better, and that would make a more significant breakout should it break above this March high at some point. But of course, that may not happen. This support could give way, and it could start to lose ground. It's we've had these signs of the possibility of an emerging trend developing in Hang Seng and also in China, which I'll click to in a moment. But it may not happen. It just may be one of these bear market rallies, which then fizzles out and rolls over. The building blocks for a potential uptrend are there. We've got the series of rising lows and rising highs consolidating above support, but needs to take that next step and now break out of this consolidation and get these moving averages turning upwards. So it's a bit of a delicate point for this one at the moment. Let's see whether it can hold this support over the week. If it can't, it just goes to this, pretty much off the burner for me at the moment, and then we'll just see how the price action develops. Just briefly over at the Chinese market, had this little breakout a couple of weeks ago. It turns out to been a false break. So we talked about this, I think, last week or the week before, once it has started to come back within this previous compression range. It's made its way back to the moving averages, had a nice strong rebound off the moving averages, which is encouraging. So it suggests there's some interest in buying the dip. But just like the Hang Seng, it's an important time. If a recovery is to get underway, I'd really want to see the market hold its footing around these moving averages or not too much below it. So yeah, let's just watch this space over the next few weeks, see what develops.
Fantastic. All right. All right. Let's start off with some questions here, Jason. We'll go to Michael. So how important are basic fundamentals for stocks that you buy, or do you just use purely technicals? If you do, what are the fundamentals that you do use?
For me, I'm pretty much just using the technicals. I don't almost. Sometimes I will have a quick fundamental overview, but for me, it's often just a cursory look. It's most of the companies I buy, I actually don't really know what most of them do. So I don't look too deeply in their fundamentals. It's really, for me, it's about assessing the price action and then building a risk management strategy around it. So I want to jump on something which is moving up, give it a bit of breathing space, but if it starts to lose that momentum and come back, well, it's a simple proposition. Then it's just like, cut it, push it out, bring something else in which has those right properties that I look for, and the properties I look for are common to pretty much every stock that rallies 100 or 200%. It's stocks which are rising above their rising moving averages. And so for me, it's all about understanding and applying a strong risk management strategy rather than going off and doing rigorous fundamental analysis. Now, that's not to say there's anything wrong with doing the rigorous fundamental analysis. A lot of people do that with great success. A lot of people combine their fundamental analysis with the trend profiling, finding the right type of price structure, and to zero in on the stocks with potential and then doing their fundamental drill down. But I don't do that. I just rely on the charts. if I was to look at some fundamentals, maybe I might look at like what industry is it in? Is there the potential for a story that the market could latch onto and really run with? So if it's an industrial packaging company, it might not seem too appealing. So I might struggle to see the story there. They might go, okay, what's the story in this environment? What's going to capture the market's imagination and take this up a few 100%? Might be harder to see the story. But then if you look at a stock, you see a breakout. You look at the industry. Maybe it could be in the mining sector. Sometimes there's an emerging company with a developing resource. It could be in technology. Technology is often an interesting space for stocks with breakouts, smaller to mid-sized stocks which aren't so well known. You see it's in an industry like tech, and you go, well, look, there's definitely like the potential for a blue sky story to develop. I don't do that so often, but if I were, that's some of the stuff I look for. Also nice to see increasing revenues there. But again, I'm not really looking at the fundamentals. Some of the best stocks I've seen haven't had rising revenues at all. They just really they've had negative revenue, but they've still gone up a lot because they've had a story which the market has been able to latch onto.
It's interesting that idea that a company doesn't make money, doesn't make profits, doesn't pay dividends, but yet they've got a rising stock price, right? So it's all about the story. But what you
and it happens a lot. Like you look at some of these booming tech companies you'll find in the Nasdaq, they just don't have a history of profitability, or maybe the profitability is relatively small or tiny compared to their market cap, but the market will latch onto the potential for what could happen in the future. And that can drive the share price. Ultimately, the fundamentals will rule on it, but the market can look a lot further forward to what could happen, and that's what can drive some of these prices to amazing levels.
Of course, you just have to look at cryptos now, right? There's not much happening fundamentally. Well, there probably is a bit happening fundamentally behind crypto's technology scene, but it's certainly not backed by profit and revenues. But and you bring up, every time I listen to these questions around fundamentals, I think it's like if you like learning about companies, if you like learning about the company reports and all that, maybe having something separate to what we would do, in terms of having a portfolio that does just purely trades on technicals, right? Because I always remember one of my old teachers in this space here, and they used to. I always asked him about the news of something, economic news, what happened, and he was just purely technicals, right? And he'd always say, look. He'd always say to you at this point here, look, do you want to make money from this, or you just want to be right, or you just want to listen to the news and think that you understand and understand what's happening in the economy and want to predict things and want to be able to tell your friends and all that sort of stuff that you know what's going on, or do you want to make money? And that was his point. And it sort of just, every time you sort of talk about these, it sort of always brings me back to those kind of points, right? It's not to say that the systems that we teach make money, right? But at the end of the day, that's the end goal, right? Is to grow your portfolio and not be too emotionally attached to the companies within it, right? So, and just grow the portfolio.
Yeah, look, take out the emotion and also take out the ego. One of the problems I find with people who try to predict the market is that their ego gets intertwined with their the calls they make. So they'll go in the news media and say, I think X, or they'll say, I think the market's overvalued and it's due to fall, and the market goes up for another month and 2 months and 3 months. Well, their call is now, well, by the definition of what they said, the market is looking expensive, it's due for a fall. The market's gone up for another couple of months. Well, it's more so then, isn't it? They're going to say, well, it's even more expensive now, so it's even more due for a fall. But then I've seen this persist for years, where people are just their ego gets so dug in around what they've said, they can't change their positions. Like, approach the markets as humble, egoless as possible, and just let the price action tell you whether you're right or wrong. If you're wrong, so be it. You're wrong. Cut the position. Pivot to another stock, or if you thought the market was going to fall and it breaks to the top side, oh well, the market's running. Let's go with it rather than continue to fight the market, going the market's got to fall. I've seen people do this for years and years and years. They get labelled perma bears, just as some people get named perma bulls. So perma is like permanent.
Yeah.
Always bullish, always bearish. The ones who are always bearish are the worst because they just scare people out of the market for years on end because they've often got a compelling story. And but it's it can be a crippling story for a lot of people because they end up staying out of the market. But if we can just watch that price action and go with the flow, go with what's working, avoid what's not working, and just don't try outsmarting the market because it'll become clear in hindsight why the market's rallying. Like people were saying during June 2020, just after the COVID lows, they're saying, oh, look, this is unsustainable, this bounce, market's going to crash again. But it became really clear afterwards that the markets were going to keep rising because of there were the fundamental factors of central banks pumping huge amounts of money in, vaccines came on board. Wasn't so clear at the time, but in hindsight it is. So just follow the price action, I think, is probably the best course to take. Understand your fundamentals if that's your thing as well. Nothing like understanding some fundamentals, but be open to the price action. Don't just get rigidly locked into a fundamental view that this has to happen, because history is full of examples where these rigid fundamental viewpoints have just been proven wrong, and you can miss out and be on the sidelines for a long time waiting for a fundamental viewpoint to play out.
Yeah, exactly. Everyone is a winner in hindsight trading, right? So, all right. So let's have a look at this next question. It's better for the market. Is it better? I'm assuming it's a question. Is it better for the market to pull back to the Fib 50 or 8%? Maybe we can do an example on the charts around that.
Is it better for the market to pull back to the
50 Fib 50? So Fibonacci 50?
Fibonacci 50?
Yeah, or 8%?
Or 8?
Yeah, or 8%, or 8%.
Oh, look, there's
it's a statement. It's better for the market to pull back to the Fib 50 or 8%. Sounds like a question.
Yeah, look, it's like looking at this current structure, I wouldn't even try and put a Fibonacci on it. These Fibonacci retracements, I guess it comes with experiences when to use them, when they're probably less helpful. So at the moment, it's not a retracement proposition that I'd be looking at. It's not clear where I'd put it. And sometimes when things aren't clear, you're just best to put it to the side and not use it, not try and just force a Fibonacci retracement over a piece of price action, because it may just be meaningless. It's like learning when to apply something, when not. So yeah, I can't really probably go much further with that one, Rog.
Yeah. I mean, at what low point would you put it there? It's just hard to like. Where are you starting it from? Because there's just been quite a few down in that trend upwards, right? So, all right. Well, let's have there's no other sort of questions, I think, in terms other than just tickers at the moment. So let's go on to the question that actually I had on my own mind, and funnily enough, someone emailed in about this question just yesterday, and I thought, how funny is that? But very coincidental. But what happens to your stocks? Like, we know all about the stocks that have a stop loss, and if they hit the stop loss, they're gonna get cut from the portfolio. But what happens when you have a stock that, let's say, jumps 20% or whatever it is, and then just doesn't move? Because I know your rule is to cut them after 6 days if they're not doing anything, all right? 60 days, sorry, 60 days. What happens if they're in the green after 60 days, but they just don't seem to be doing anything? They're just going sideways. What do you do with them? What do you do with those stocks?
It's good question. It's so just a little bit of background. So when I buy a stop. So a stock breaks higher, I buy a position. I'll have 2 exit points. I'll have the calculated stop loss. So if it reverses tomorrow and starts coming down, falls over the next few weeks, hits a stop loss, I'll be out. There are other stocks which will break upwards, and then they'll just sort of like, pull back. They might pull back 5-10%, and then they'll just meander sideways. And there's something I noticed during back testing. When I do back testing, I'll go back through a whole lot of stocks and just see whether there's a pattern of winners or losers that maybe there's a rule that could be useful, that could help enhance winners or reduce losses. And what I found was there was a lot of stocks which would, fair number of stocks which would trigger an entry, come back 5-10%, then just go sideways for months and months and months, and maybe eventually fizzle out or much later go into an uptrend, but just take forever. And there were better opportunities coming out of that stock and jumping into something which may be on the move now. So 60-day time exit, I give it 60 trading days, not a magic number, could be 70 days, could be 40 days, could be 100 days, but it's a defined exit point. If the stock's not working, get out, go elsewhere. If a stock rallies and then starts going sideways, well, I'll hold it. If it's in the money, I'm happy to stay in there. It's often these stocks be paying dividends as well. So you get paid to sit there in a profitable position, let it consolidate, and then potentially let it run on. I'll show you an example. From, this is a stock I currently have in my portfolio. It's a company called Ridley Corporation. So it's involved in pig farming, I think. From my last time I looked at the background of this stock, it's this green circle. This is where I bought it. It was November 2021, and so it's a motion trader stock as well. I think this green circle. We've looked at this stock somewhere in the past. That's why it's in memory, and that's why I've got these green circles marked. This was the motion trader entry when the moving averages crossed. Price broke higher. There was an entry point. I didn't buy then. I had capital was elsewhere. I followed a later signal. And so as I often say, there's many profitable entry points to get in on a big trend. Doesn't have to be on the ground floor. You can get in a few floors up and still do it really well. So I bought this later signal, and kind of like what you were just saying, Rog, like initial rally and then sideways. And but I held. That was okay. Then another rally, and then we've got this other sideways period. So this stretches from April through to August. So multi-month sideways consolidation, which includes a sharp decline to at the end of it. But of course, I got my wide trailing stop, which is sitting nicely below the market. I can see that off. A lot of people wouldn't see that off. They'd have a close stop, probably just below a previous low, and be taken out. Not so if you got that wide stop, you see off a lot of these pullbacks. But you can see, and then look at this one here. This is a lengthy sideways period as well. That's another multi-month sideways period. But from where I got in to where it is now, that's about an 80% gain over what would say 2.5 years, up 80%. It's paying something like a 3.5% dividend. So I'm collecting constant dividends along the way. So I'm happy to be patient with my winning stocks, patient with profitable stocks. If something's making me money, it can take its sweet time to go upwards. I'm happy to be patient. Something's cost me money though, is in the red. The clock's ticking. It's like, okay, you're in the red, start doing something worthwhile or you're out. So be patient with your winners, be impatient with your losses. That's all part of that capital protection mechanism. So if you're impatient with the losses, you don't give them too much leeway to get out of control and be down 60, 70, 80%, because you're constantly like throwing them out if they're not doing the right thing. But by being patient with the winning stocks, if it takes me 2.5 years to get 80%, so be it. I'm happy with that. If I can make it in a year, even better. But if it takes 3 years, 4 years to get 80% gains, that's great. That's that's sort of like, you know, this is, I'd describe this as it's not one of my top performing stocks, but it's an upper middle performing stock. And yeah, you build the meat of your portfolio has a whole lot of this sort of stuff, like Ridley, which you're being patient with. It's the, I think it's the underpinnings of a strong performing portfolio.
Yeah. Well, it's a great response, and I'm glad we asked this, because I've got a few of these ones that are just small, slightly in the green, and I started to wonder, well, maybe I could just cut out of it and get into a better position. But I think for me, it's kind of one of those things that that should answer the viewer's question as well. Is if it's in the money, if it's in the green, then hold, and then if it's in the red and you about hit your stop loss, you're out. Or if it's in the red and past 60 days, well, they're your rules. Obviously, you can use whatever day time lapse you want, but yours is 60 days. If it's in the red, it's out. Is that right, Jason?
Yeah, that's it. 60 just worked out well in back testing. Like, there's a whole range that worked out well in back testing. I can't remember all the details now, but if I was too impatient, gave it 10 days, it was just too much churn. If I gave it 200 days, it didn't really make much difference because it was hitting its exit stop anyway. So, you know, around 60, like, I would have, chances are like 40 to 80 probably would have been working well. Again, I don't remember this. I'm just sort of like, you know, giving some rough parameters, but 40 to 80 probably would have been, would have been effective. So I've just taken the midpoint. That's how I come up with a lot of the numbers I use for these indicators, taking midpoints from a meaty area where it shows it tends to work. And if there's a stock I want to buy and I don't have capital, if I were to sell a stock to free up capital to buy something, it would be, I would get my worst performing stock and lob it out. And then the one which is just above that, my second worst stock, that would be the next to go. A lot of people do it the other way around, though. It's interesting, isn't it? A lot of people will take their best stock and go, okay, well, I want to hold my losing stocks because they owe me money still. I want to give them more time to pay me back, but I'll sell half of my best stock, which has been working the hardest for me, to raise some capital. It's and this is where it's just an interesting thing with trading and investing, that intuitively people get it. You know, they get it upside down. So if you want to raise capital, my preference is to sell the ones which are working the least. Sell your lazy stocks which aren't performing. Keep your performers. Don't do it the other way around.
Yeah, exactly. And it's actually, there's an analogy here with shops as well. Why do they sell everything that doesn't sell in their discount prices, right? Because they've got to get it, they've got to turn over the stock and get it out of there and free up capital for new stock, obviously, that hopefully will boom and things like that. And then obviously keep on selling the winners. So I remember hearing that analogy as well, and I thought it was a great analogy to compare to share trading in getting turning over stocks, right? So all right, well, let's go on to the next question. And this is a bit of a loaded one, Jason. It's to do with slippage and mitigating slippage. But I'm going to read it out here. When the COVID share market crash did suffer a slippage, and during that time, did you have to sell a lot of shares at one time, or did Motion Trader get you out in dribs and drabs before the COVID crash was in full swing? There you go.
Yeah, it's a really interesting one. It was the COVID crash was probably the greatest stress test of anyone's trading or investment system in living memory, because there's been nothing like it. It was like if your process came through that COVID period and you're still in the game and your equity is higher than your trading capital is higher than it was at the COVID peak, you've got a robust system. It's so many things. Just so many people would have been probably just left the market during that period. It's I'll get a chart of the. Let me get a chart of the All Ordinaries up on the screen to talk through. And so I sold a lot of stocks during that period. Basically, I think my portfolio went to it was a complete clean out by the bottom. I had no stocks left. So this initial sell-off in February, plenty of stocks went during that period. This was relatively orderly still. So I wasn't there, from memory, there wasn't a great deal of slippage. There would have been a bit, but nothing which was out of control. It's during this second part of March where things really got a bit volatile and a bit crazy. But all the while, I was raising cash. So I think my cash balance would have been going up on an almost daily basis, and I wasn't entering new trades. For me, there was no buying the dip during this phase. It was a case of stocks hitting their exit stops and getting out. A lot of the stocks I trade are at the smaller end of the market. Liquidity can be patchy at times, particularly when you start getting some volatility. What I was often doing was a stock would hit its exit stop, and I'm using end of day exit. So I'll see what's exited during the day, and then at least that's what I was doing during this initial portion, and then I'd sell the next day. And often it'd be a case of when a market sells off reasonably aggressively, particularly at the smaller end, there's often a knee-jerk reaction back up over the next day or two. And so I was placing sell orders above the market and waiting for letting the price come up and hit my sell order and getting out that way, rather than just sell at any price. Just say, like, I need to sell X amount of shares at market, and just hitting the bids on the way down, because that can be tricky when you're trading when volume's patchy at maybe the best of times, let alone when you've got these sort of selling coming in. For the most part, for a large part, that probably worked quite well. When things got really ugly during March, that strategy, I had some significant misses trying to do that, and I got stuck in a few stocks that just continued to decline. I'll show you an example of one which I remember, which was just a mess trying to get out of. It was Air New Zealand, and where's my chart? Here it is. Now let me go back. Let me find the COVID period. So here it is here. So I had an exit stop, roughly on the chart around where the cursor is now, in early May, and I was using that process of I think volume was probably a bit patchy. It was well stretched below the moving averages. I thought maybe I could get out of it on a little bit of a rebound. I wasn't too aggressive with where I put my sell, but what I found with this stock, everywhere I'd put my sell, the market would get within about a cent of it and then decline again. So I kept adjusting my sell, and the market kept missing it, and the market kept declining it. So I was getting myself stuck in this position, and it started to gap lower. So it was getting towards the middle of May. I just bit the bullet and I sold it. Just cut the position and took a larger loss than I needed to take, that I should have taken. But it was the right decision to do that, because soon after that, a couple of days after, the bottom really fell out. So I'm glad I bit the bullet and sold. But yeah, so I've definitely had slippage through that period. Lessons learned from that were, it's easy in hindsight, but it's harder in real time. You're not letting a stock get away from you. This one started to get away from me, and there are others as well. But trying not to let that happen. It's but as I say, it's easy in hindsight, because you can see the chart and you can see where, okay, now I've just got to sell it. I can't wait for any sort of a rebound. But I guess part of my approach is many relatively small trades. So that, for me, I feel it gives me the it gives me the confidence to try and get a rebound sometimes in these volatile situations. If all my capital was in one stock, it's like, well, it's waiting for a rebound is perilous, because what if it opens down 50% tomorrow? You're down 50% of your capital. If I've got 1% of capital in Air New Zealand, or 2% of capital in Air New Zealand, and it opens down 50% tomorrow, well, I've lost maybe 0.5% of capital. It's annoying, but it's not the end of the world. And this is the beauty of that relatively small trades approach. It does give you can try and find the best way out of in these times. But look, the COVID decline was something we rarely experienced, thankfully. I was busy during that period, placing a lot of trades and having to manage those trades around getting the volume through. Sometimes I'd need to sell a stock and I'd see the volume I needed was on the bid and it was 2 or 3 cents below where the market last traded, and I'd just hit the bid. I'd just be done with it. I'd pay an extra 3 or 5 cents, whatever it may be, because I could see the volume there, so I'd just take it. Other times I'd try and work my way out. Worked well sometimes. Other times, in this case, didn't work so well. So that's what I did after this period. Is I reduced my position size by doubling the number of stocks in the portfolio, just to make myself more maneuverable during periods of market stress where I needed to exit stocks quickly. So it means there's more stocks to exit, but more amounts of capital on each stock. It's but look, slippage is something we're always going to get. No stop loss. Stop losses are great, but they don't guarantee you're going to get out at your level. Most of the time you should get out pretty close to your level, but there are going to be exceptional times where you're not. My portfolio from peak to trough in COVID was down about 22-23%. All ordinaries was down, I think, about 39%. Didn't quite get to 40. I think it was 39%. So the exit stop strategy worked. It worked well. The portfolio was down close to half of what the market was down. So, but it can be messy trying to get out of some stocks.
Lucky it doesn't happen that often, eh? Let's hope it doesn't happen again. Anyway, not anytime soon. All right, let's have a look at some stocks now, Jason, if that's all right. Alligator Energy stock. So I don't know. Maybe we can just type that one in, unless you know what it is.
No, I don't know that one.
Yeah, maybe Alligator Energy Limited. So AGE. Let's try that one.
ALL, that's the one. Let me just see where it's come from. Look, there are some makings of upward momentum. It could be uranium related, but I don't know. At the moment, I'd just if I had it from lower levels, I'd still be holding it because it's in the money, and I'd giving it the wide trailing stop. If this pullback hadn't taken me out, which would be getting pretty close, I might give it a little bit more time. I wouldn't buy it at the moment because we've got the market going through this period of whatever it's going to turn out to be. Consolidation would call it at the moment. The uranium space itself, I'm only guessing it's uranium just because it's alligator, and it's the Northern Territory type of term for some of their companies. A lot of uranium speculative stocks in that part of the world. Could be wrong. Could be oil or gas.
It's definitely uranium.
Is it uranium?
Yeah, it's uranium.
Yeah. It's with uranium space generally, like having a bit of consolidation as well. I wouldn't be in a hurry to buy it. If I owned it, maybe I could keep it, give it a bit longer, but I'd know where my exit point would be. But I wouldn't buy it at the moment. I'd just, this could chop sideways. See if it does chop sideways, maybe that creates a bit of a base we get a breakout from. That could create the entry opportunity, but we don't know. We've got to let that price action develop. So for now, might be a hold if someone's got it, but it's for me not a buy.
And there you go. I think Michael Lim, who asked the question about fundamentals before, I think he had to go, but there is an example of Jason talking just slightly about our fundamentals maybe influencing your decision there in terms of the uranium sector. So, and what it's doing.
And that's all based on the price action as well. So fundamentally, I'm not having a viewpoint on uranium there. It's just like looking at where the price has gone over the last 6 months. And I've been saying for a bit now that I think uranium is set for a multi-month consolidation. So if uranium does have a multi-month consolidation, there's probably no hurry to buy a stock like Alligator, which is probably at the early stages of trying to prove up some sort of resource, or I don't know the fundamentals behind it, but it wouldn't seem like a hurry to get in if we got a multi-month consolidation in uranium.
Yeah, fair enough. All right, A4N from Steve. A4N.
Well, the upward trend is, I think broadly you'd say that, look, is the upward trend in place still? It's sort of like more going sideways at the moment. It's just, it's oscillating either side of the moving averages. This could well prove to be a pause and a basing phase before another rally. It's a stock which has been in a long-standing upward trend, and it does have a history of having strong rallies and then lengthy pauses and then getting going again. It's done that a couple of times. So this could be another lengthy pause, and then maybe it re-engages. If someone were in this from good levels further back, by all means, I'd be probably holding it a little bit longer. I'm not sure whether or not it's a motion trader stock, because this is a pretty sizable pullback. That probably, I'm guessing, would have taken out a motion trader stop. So it wouldn't. I don't think it's in the motion trader portfolio at the moment. So for that to happen, it would need to break higher again, get these moving averages positive. So it's probably not one I'd buy at the moment, but it's look, if this goes sideways for a bit and starts to break up, there could will be a new opportunity there.
Okay. What about DRO?
So hasn't this been a good stock? Looked at this a few times. It looked like a larger consolidation might have been coming in back in March, but it stabilized really quickly around that 50-day moving average. So we've talked a lot about where do you buy the dip? You buy the dip back towards the 50-day moving average. And my thoughts when I saw it come back to the 50-day moving average, I thought it might have done some more sideways and sort of headed towards maybe the 100-day moving average, because it had such a strong run. But it's just continued to fire up. So anyone holding it, and I'm holding it myself. So I'm continuing to do so. Trailing stops, well below current levels. I just let it ride, see where it goes. Hard one to buy at the moment though, because it is elevated above the moving averages, and we're in an environment where there's a bit of volatility coming into the market. So I don't know that it's an asymmetric entry level, but it's certainly a hold.
Mm-hmm. And what about QIP?
I hit the wrong one. Try that again. So this is a legal services company. I know that because it's a motion trader stock, and I've spoken about it in the past, and I've looked at some of the fundamentals. It's like it's in the motion trader portfolio. So the strategy here is let it run, use a wide trailing stop. Just compressing this a bit. Yeah, like, it's from where it's come from. It's still, I guess, it's sort of like getting mid-range from its price history. That doesn't really mean a great deal. It's just of interest to see where something comes from. Look, it's not a stock I'd probably want to rush to buy at the moment. Just as I say, with the market volatility creeping in, and this is stretched above its moving averages. But it's a stock I'd be holding. I don't want to try and guess where the high is going to be. I don't want to get scared out of my good positions on what could be modest pullbacks. I want to give them the benefit of the doubt. I want to try and stay with them, and that means giving them some room to chop about, maybe come back to the 50-day moving average, maybe continue into a larger trend. That's what I want to try and do with stocks that I have. So that's what I'd be doing with this. It's interesting to see this little chart pattern as and this was like, it's a little bit late to act on this one now, but this is the sort of price action I like to look at, from below the averages to above the averages, sideways consolidation back to the averages, and then you get the breakout. Another little sideways compression there, and then another breakout. So you can see the stepping stones into an upward trend. So yeah, this is for me again a hold on tight and see where it goes.
Yeah. All right. Very good. And what about MEI?
Yeah, this is interesting. It's so this is a small, I think, gold, and just looking at this sideways range it's been in since June last year. A little bit of a false break, perhaps you could say. So we've got a previous low point in August, dipped below there in February, didn't get any follow through selling, came back up, consolidated sideways and pushed back above the moving averages. Now we're going sideways again into the averages. Not dissimilar to the sort of scenario I was talking about with QIP a moment ago, where it's going sideways into the averages. The average have crossed and turned higher. This is the sort of stock I'd be looking for a break to the top side. So, like, maybe this range continues to compress, and then you start to see it break to the top side and go for another run. So for me, the play would be, buy the break. You look at these previous highs around 25.5. So the break might be a touch higher, might be at 27, something like that. Someone could feasibly buy it now, so they're buying the dip back to the averages. Then you've got to work out where's the exit point going to be. Let me just measure that. So look, I think you've got to give it a bit of room if you were to buy it there. So you're talking 15, 20%. But then you're in a little bit earlier, or the alternative is you're waiting for about 27. So you give away 16% because you got to, you're buying it later. You're buying the breakout. So you're buying it 16% above, or you're putting a stop loss maybe 16, 20% below. So we're kind of like in the middle of those two zones at the moment. But yeah, I think it's a stock with potential. Potential doesn't always deliver, but you can see the possibility there for something that could develop into something quite interesting.
Okay, and Peter's looking at S32.
Yeah, I think we might have looked at this last week or the week before, and these averages are continuing to roll higher. So the first part's done, from below the averages to above. And what I probably would have said last time was just wait and see what happens. Do we get that again, that sideways compression as the moving averages cross, and then start to get a break to the top side? Potentially there's potential for a head and shoulders bottom to fall. So that's potentially a shoulder in when's that, October through to January. Then you got the head, February through to April. Maybe, and this hasn't happened yet, that's just me drawing something in, maybe you get the right shoulder forming over the next couple of months, and then get a breakout. So I can see pathways that could take this higher, or is that more just that classic compression into the moving average setup that we look for than the breakout. So the potential is certainly there for this to turn into something. Yeah, probably needs a little bit more time, but it's definitely one to keep close on the radar.
Okay, and GLV, this oil and gas.
This is a tricky one just because it's a low price stock. Like, where do you put your exit stop? If someone bought it on this breakout above the moving averages, great. If someone's in from good levels below 3 cents, terrific. I'd certainly be holding this and see where it goes. I don't know the backstory in this stock at all, but it's coming from next to nothing. But it's a harder one to say, look, do you buy it at current levels? Because like it is stretched above those moving averages, and you say, well, look, if I bought it at current levels and put my stop below the 50-day moving average, I need a 45% stop loss. So that's it's pretty extreme. Where do you put your stop? So is it an asymmetric entry point? And I'd probably say it's probably not an asymmetric entry point, even though like it being such a low price stock, there's heaps of upside potential. But are you comfortable risking 40%? It's like it's a big amount of capital to be risking on one stock. My preference would probably be see if it consolidates, see if the moving averages catch up, see if you get another base forms, and then once a base forms, then you have some more structure to work your risk around. So you can say, well, like let's just say it chopped sideways and then started to break up. It's a pretty messy sort of range the way it's drawn it out. But then at least you go, okay, look, I've got a low point. I know where my low point is, so I can buy the break. I've got a low point. I can put a stop below there, and you've got something to work with. At the moment, we don't have much structure to work with. We just got like a vertical line up. So for me, if someone's got it, fantastic. Let profits run, see where it goes. If they're interested, see if we get some sort of pause, and then use that as possibly your setup for getting in.
Okay. All right. And lastly, SPZ.
I recognise this as a motion trader stock, and we're getting that pullback to the moving averages. So it's not sure when this triggered, whether it triggered in September or whether it triggered in July last year. But yeah, it's in the portfolio, wide trading stop. So it's going to remain in the portfolio for now, whilst it remains above the trailing stop, which is probably back, just guessing, maybe back around 30 or so. So plenty of room to move around. Like if someone was looking at and thinking about buying, like, do you buy this dip back? Just like buying the dip back in January worked out quite well. We're back at that potential buying point. What would make me hesitant to buy the dip at the moment is that we do have a broader market pullback going on, which we don't know what depth it's going to be. So if you've got the market generally moving upwards and an individual stock is coming back to those averages, well, that can be a good buy the dip point. But yeah, we don't know what the market's going to do. So if the market continues to come off, I'd suggest smart parking would probably see more of a pullback as well. So I'd probably not be cautious about buying. I'd probably rather buy a bit of a rally. So if it started rallying back up through 45 cents, maybe look at the structure then. That could then be so you're buying the rebound off the averages rather than just punting the moving averages are going to hold in the current environment. But if I've got it, yeah, I'd be hanging on.
Okay, fantastic. I think we'll finish up with the looking at the ticker codes for today. There's a couple of questions in there which we might have some quick fire answers to. Well, obviously, you don't use automated stop losses, do you, Jason? Let's see if I'm listening here. You do them every day. You just sell a position off. Is that right?
Yeah, I look at I'll get the end of day data and I'll run it through the system, do the calculations, and just see which stocks have hit their stop losses or their trailing stops through the day. Then I'll sell them the next day or soon after. For me, that works well. Many relatively small trades. My risk with any single stock of it opening, gapping lower the next day, it's still relatively small. If I've got a larger position, like if it's a stock which has run 400% and I know it's around the stop loss, well, then I might be more monitoring it more closely. I could sell it through the day if it hits the stop. But if it's just your run-of-the-mill stock, I'm usually happy to sell that the next day or soon after. It frees up a little bit of portfolio management time, so I'm not constantly updating stop losses in the platform. But it depends what works for everyone else. And if I'm using leverage, if I was trading futures contracts, for instance, I would always have a stop loss in the system because that's dealing with leverage. So when you're dealing with 1% of your portfolio, well, it's not going to be a portfolio moving event if you get a bit of slippage. If you're dealing with leverage and you get a gap lower, it can be a portfolio ending event. So you've got to be very careful with leverage. So it depends depends on your own situation.
Yep. And obviously with stocks and ASX stocks, the self-wealth system actually has an automated stop loss which you can put in. And if you have any questions around that, you can always just send an email to support around that. Obviously, we'll help you out with that. Okay. Now, I'm assuming with the ATR stop system that you use, it's always a 10 times ATR. Doesn't matter whether it's a small cap, mid cap, or large cap stock. Is that right?
Yeah, I use 10. I keep it consistent for everything, but it does dynamically adjust to the individual stock. So a large cap stock will often tend to have those smaller ranges. So an ATR stock may travel closer than a smaller stock with wider ranges. So it's still a multiple of 10, but it's a multiple of a smaller number. The ATR will be smaller, typically in the larger stocks. So it's the beauty of the ATR method is that it dynamically adjusts to the individual situation rather than a stock standard 20% for everything sort of thing. So, CBA might move in a 20% range all year, but then a mining stock on the fringes of the All Ordinaries might move 15% in a day. So, but the ATR will adjust for that.
Yeah, fantastic. And just one more here. I think I missed this one here. What instrument would be best to capture any market upside to oil? I'm not sure how you would answer that one, but
there are oil ETFs. I'm not sure that they're listed on the ASX. You just Google in oil ETF and see what comes up. But the self-wealth platform, you can buy US listed ETFs. So that's fairly straightforward. And there's an oil ETF there. There's an oil and energy company ETF. XLE is the ticker code. That's one of the stocks I've been talking about in my Friday strategy sessions, which I do. I've been talking about XLE as one of the ways to play the oil price over the last month as its upward trend's been bubbling away. But yeah, that's one of the ways. Look up oil ETFs, and you can play. The thing with XLE, it's going to have a lot of oil and gas companies. So if it's purely oil that you're interested in, maybe it's an oil ETF, which is often they base it around futures contracts, but the ETF does all that, and the individual's just buying into the ETF. I don't have a lot of experience with them. I don't trade them, but I know they exist, particularly in that US market.
All right, fantastic. All right, Jason, thank you very much for today. Thank you for everyone with your questions and your suggestions to have a look at. Always remember that anything we say or do on this show is general guidance only. There's no personal advice given at all. Please do your own research on everything. And like and subscribe on our channel, and send us comments, send us questions in whichever way you want to. I'm from Self Wealth. You can always hit me up and say hello, obviously via our support channels and whatnot, or even this YouTube channel here. Jason's from Motion Trader. You can hit him up anytime through his website. The links are down underneath this video right here. And you can get a free trial of his service as well. All right. Thanks, Jason. Have a great day ahead.
Thanks, Roger. Thank you, viewers, for coming along and joining us today. And yeah, we'll be back next week.
Back next week. All right. See you, everyone. Take care. Bye-bye.